My name is Lucas Sater. I'm the Region 4 Webinar Chair for the Maryland HFMA chapter. I want to thank all of you for joining us on this Friday. Today, I'm excited that we have with us Andy Connor and India Suter from Asset Strategy Consultants, who will be presenting on the endowment model of investing. I'm going to let them do a little bit more of a detailed introduction as we get the presentation started. But before we do that, I just want to go over a couple of housekeeping items. Just as a reminder, there is one CPE credit available for attending this webinar. You just need to make sure that you answer the 3 polling questions. We're going to have 3 polling questions throughout the course of this presentation. One towards the beginning, one in the middle, and one at the end. In the handout section of your GoToWebinar panel, you'll see that we do have this presentation in a PDF form that you can download and review as you'd like, and let me know via the chat module if for whatever reason you're unable to download it, and I'll send it out to you individually. And lastly, if you have any questions throughout the course of the presentation, please feel free to type them into the questions module on your GoToWebinar panel. And what we'll plan on doing is we'll get to those questions during the Q&A session at the end of the presentation. So with all that being said, I will go ahead and hand it off to Andy and India.
Good morning, and thank you for taking an hour of your time for this HFMA webinar. My name is India Suter, and I'm the Director of Business Development at Asset Strategy Consultants, as well as a member of the board at HFMA Maryland. Today, we're talking about the endowment model in a presentation entitled, "Is the Endowment Model Right for You?" This session is for those who take part in overseeing endowments, foundations, pension plans, and operating reserves. This model was popularized at Yale University and has been extremely successful. Today's presenter and my colleague Andy Connor is our Chief Investment Officer here at Asset Strategy. Andy joined ASC in 2019, coming to us from Johns Hopkins University, where he was the Deputy CIO and Interim CIO. At Hopkins, Andy worked on the investment team that oversaw $7 billion of hospital and university assets. Andy has an extensive knowledge of alternative investments and the experience of working with an investment committee and their different dynamics. Andy has a BS in finance, a master's in economics, and is a CFA charter holder. Let's go over our objectives for today. So we're first going to see what is the so-called endowment model of portfolio management. Does the endowment model still work? And what are the prospects for endowment model portfolios over the coming years versus the last decade? Before I turn this over to Andy, we're going to go ahead and start with our first of 3 polling questions.
Okay, thank you, India. All right. First poll. Who feels they have a good understanding of what they own in their institution's portfolio and how it all fits together? I'm going to leave the poll open for about 60 seconds. I'll give you about a 10-second warning before I close it. Okay, about 10 more seconds. All right, so responses. We had 30% say they do and 70% say they don't.
That's very interesting. So thanks for the introduction, India, and thanks for the opportunity to share some of this information with everyone today. It's my goal to make it as engaging as possible. This is a topic I think, it really, I find it very interesting and exciting, and I've dedicated much of my career to it. I know that's not the case for everyone, but we'll try to make it so that there's something that everyone can take away from this. The term endowment model is one that's used quite a bit and may have different meanings to different people. It's my goal to really share the original definition of that, as well as how it can be applied not only to endowments, but to other types of portfolios, pension assets, operating reserves, those types of things where they may have some shared characteristics and can successfully implement some components, if not the endowment model in full. But I'll start with the origins. And so Alex Rodriguez, the famous and infamous shortstop and later third baseman from the Seattle Mariners and the New York Yankees, as he moved into his post-baseball career, and he's just launching a SPAC, a special purpose acquisition company, in the last few weeks, but he's moved into different areas outside of baseball, entertainment, marketing, and finance. And he's known for asking people, as he tries to learn about a new industry, who's your Babe Ruth? So who's the Babe Ruth of your industry? And for me, someone who's dedicated most of my career to the endowment model, our Babe Ruth is David Swenson. And David Swenson really originated and pioneered what is now known as the endowment model at Yale University. In 1985, at the tender age of 31, he became the chief investment officer at Yale, where the endowment really was only a little over $1 billion at that time. And he had earned a PhD at Yale, and then he spent about 6 years on Wall Street, and then he was enticed to come back by members of the investment committee who remembered him from his graduate school days. And he really came in and took a new, fresh approach on managing this portfolio, really examining what were the opportunities, what were some of the limitations, and then, frankly, because he came from outside of the traditional portfolio management industry, took a fresh look and really went back to basics and first principles. And the result is what he developed, along with some other contemporaries of the time at other large endowments who they worked together and shared ideas, is now known as the endowment model. So Yale has had a tremendous amount of success with their endowment over the last 20 years, and this is through mid-2019, because that's the latest full report we have from Yale. They issue an annual report, which actually gives some good information about how the portfolio has done, and that report hasn't come out for their fiscal year ended the middle of 2020, so this is as of 2019, an 11.5% annual return. As I said, the endowment was around $1 billion when he arrived in 1985. It's now $31 billion, and that is after paying out, at this point, just about $1.5 billion per year to support Yale's operating budget. So as that payout has grown, the endowment now supports over 1/3 of Yale's operating budget each year. And the other interesting piece is they've not only been very successful at Yale, but beyond the walls of the university. They've published research, he's published a book, and they've really originated some models and methods that have become industry standard among large endowments and practitioners, consultants, for things like determining payout, such as using a moving average payout rule to smooth payout, commitment pacing model, so that's for committing to alternative investment partnerships and how you use a policy to reach your target allocation, as well as just standards for manager due diligence. And the other aspect is he's really put his fingerprints on the rest of the endowment world, as people who worked closely with him have left Yale and moved out into the industry, and people who were senior investment professionals in the Yale Investment Office at one point or another, and many of them still are, chief investment officers at Harvard University, Princeton, MIT, Bowdoin, the Carnegie Corporation, University of Pennsylvania, Wesleyan, and the Rockefeller Foundation. And many of those have also experienced a lot of success generating top of peer group type returns by employing the same endowment model. So before we delve into what was so revolutionary about Swenson and Yale's approach, I think it's worth taking a step back and we can talk about what's called modern portfolio theory, something that I learned about in graduate school, and that was developed by Harry Markowitz, who won a Nobel Prize and then based on work he did in the 1950s. And so this is a graph, and I'll explain what's going on here. Essentially what I did was, as we look at portfolios, we organize different types of investments into what we call asset classes, so such as US stocks, US bonds, private equity, hedge funds, different categories like that. And so what I've done here is you can describe each of those asset classes based on some different statistical measures, such as what do we expect the return of that asset class to be? How much risk do we expect that each of those asset classes to have? How volatile? How much does it, go up and down by standard deviation? And then also, how do those asset classes interact with one another? So how well correlated are things like stocks and bonds to one another? So if we know those pieces of information, or if you have assumptions about what those things will be in the future, you can then combine a portfolio of those different asset classes and then predict what will be the expected return of that combination, as well as how much risk that combination will have. So this is what asset allocation is all about. And what I've done here, this is a very familiar graph to people in the industry, with expected return on the y-axis, and then how much risk going left to right on the x-axis. And so each of these, you can see there are actually thousands of little blue dots on this graph that make what's called a cloud. And each dot represents a different portfolio. So I have basically computed every combination of 5 different asset classes in 5% increments, from 0% cash to 100% private equity, and everything in between with 5 different asset classes. And each time I calculated a combination, I determined what the risk and returns of that portfolio would be and plotted it as a dot on here. And so this is really your investable opportunity set of every possible portfolio you could own. All of the dots are here, subject to those 5% increments. So the next step associated with this type of analysis is to develop what's called the efficient frontier, and that is shown here on this slide in red. And these are portfolios that, among all those points in the cloud, are considered efficient. So they have the highest amount of risk, or sorry, apologies, the highest amount of return for every point of risk. So if we just pick a point, say on the horizontal axis where it says risk standard deviation, and we look at the line where it says 15%, and we trace that line upward, follow with our eyes all the way up to the red line, you can see that there are many portfolios with a level of risk of 15%, but there's only one that has a maximum amount of return at that level of risk, and it has around 10% risk. And so Markowitz really was revolutionary in saying you could have many different kinds of portfolios, but there are only a small subset that are really worth pursuing because they're efficient, or you're getting the most bang for your buck for how much risk you're taking, or conversely, for a given level of return, you're taking the minimum amount of risk to obtain that return. So in practice, many of us actually don't compute that entire efficient frontier. We subject our portfolios to constraints, and we do this for practical reasons. So for instance, I did the same exercise to develop this cloud and frontier as I did for the prior one, but I put in some limitations, and I said basically no more than 25% international equity and no more than 10% private equity. So you can see just by putting those somewhat artificial, but maybe rational limitations on your opportunity set, you really reduce dramatically the number of options you have. And again, if we go back, there are all these portfolios up at the higher return end that by capping the amount, in this case of private equity, you never will avail yourself of if you impose these constraints on yourself. And as a practical matter, as at the time in say 1985 when David Swenson arrived at Yale, the industry and the asset allocation process that was being advocated by managers, investment counselors, consultants was one of using model portfolios. So in this case, I've put a 60% stocks and 40% bonds as a very common portfolio for pensions in particular, a 60-40 portfolio. And then it's on the right side, I've got a table where I've basically broken down into what are called style buckets. So break out large cap, mid cap, small cap stocks, and then divide it between growth and value. And then to do the same for international markets, have some allocation to emerging markets, and then divide up our bonds between things like core bonds, maybe some high yield and emerging markets. And so this, which is called a style box approach, where you seek to fill up these boxes and make sure you have exposures and managers in every box, was really the state of the art, and still in many cases is. But when David Swenson arrived at Yale, he didn't have this preconceived notion of this was how you should build a portfolio. And frankly, when he came up with, his ideal way to do it, this is not what he arrived at. This, frankly, can be a very effective way to do asset allocation and to diversify a portfolio, but it also is arisen, at least in part, out of providers who are looking for ways to systematize the asset allocation and roll it out across many clients rather than having a custom portfolio for each of their client, which is derived independently. This is a way to avail yourself of scale as an asset manager, rather than taking the best interest or necessarily the custom circumstances, the unique circumstances of each client into account. And again, it works because many investors have common circumstances, but the Yale model does not take this approach. So David Swenson in 2000 actually published a book called Pioneering Portfolio Management: An Unconventional Approach to Institutional Investment, believing very fervently that he would rather, whereas most of the industry was fine with failing, provided they failed conventionally, he would rather take an unconventional approach in pursuit of doing much better. And essentially his book, which I recommend to anyone who's interested in this topic, is really has a lot of detailed information, and he lays out his process at that point in time. And I would, it has evolved since 2000, but it's a really great early text and description of what the endowment model means and how it was developed. And so there's really four, I would boil it down to four tenets. One being that every decision that you make has a rigorous analytical basis. So not just doing things because that's what's done in the industry or it seems to be the right thing to do, but actually doing first principles analysis on every single decision. The other is to invest for the long term, and endowments in particular have oftentimes what could be considered an infinite time horizon. And so they have an ability, along with other long-term pools, to invest over a 5, 10, 15-year time horizon, whereas most investors in the markets, most participants, are focused on, frankly, next quarter's earnings or maybe a year out company earnings at the most, and taking this long-term approach, which they have by nature of the fact that they're an endowment, and utilizing it to, as a competitive advantage in investing is really unique. And frankly, I firmly believe when I was at Johns Hopkins and we were managing the endowment that our greatest competitive advantage was the fact that we had this luxury of a long-term time horizon. It enabled us to look out where most people were not looking in terms of time horizon. The third point, a very important part of the endowment model, is it's an equity-like portfolio. I think he acknowledges very early in his book that bonds, even at that time when interest rates were much higher than they are now, were not sufficient to meet the goal of making a payout and keeping up with inflation and achieving equity between today's students or constituents and those of the future. So equity and equity-oriented portfolios, but very importantly, a diversified set of equity-like investments, not just loading up entirely on domestic equities, U.S. equities, and or large cap equities, because that's too risky. You really need to work hard to find different sources of less correlated equity to put in the portfolio, and I'll talk about where some of that where that led them in a couple of slides. And the fourth very important part is active management. Manager-specific return has the possibility, if you can find truly talented managers, of adding an important source of return, but also doubly important, that active return can be a diversifying function or a factor in your portfolio, because by definition it's skill-based and it's not derived from just being in the market. It's not it should be uncorrelated and should persist in times when the market is down. So it's an important buffer. It's an important part of the portfolio. It's also an important diversifier. And so what these four set of principles really led them to was not only to have traditional assets in the portfolio, such as liquid and traded stocks and bonds, but also move into illiquid investments and alternative investments in a significant way. And as we look at it today, for most endowments, that's a hallmark of the endowment model in those portfolios we see today. And we've seen other long-term pools, pension funds move into alternative investments over time as well. So really what David Swenson did at Yale is to kind of implement the type of portfolio that you would after you learned academically what portfolio management should look like, rather than what it had become. And so one of my partners at Asset Strategy we've discussed this over time, and he gave me a really great analogy, which is on many golf courses today, there's been a history where, for conservation reasons and that sort of thing, they have over decades let the trees that existed on the courses grow, right? So the trees were growing up. That was a great thing aesthetically, but now they're starting to cut the trees back. And the reason being, it was a good thing. In other words, similar to moving portfolios into a rigorous and analytical and stepwise process that led to model portfolios was a good thing. By allowing those trees to become overgrown, it really kind of clogged up the greens and destroyed the sight lines and that sort of thing. And so coming back and clearing some of that has actually led to an incremental step forward and an improvement. And so basically an endowment that has a very long-term time horizon, fairly low, typically around 5%, and fairly steady annual payout policy, can be freed up to avoid what could be artificial or psychological constraints, concerns with short-term volatility, which doesn't feel good. But frankly, if you're a long-term investor, the fact that your portfolio is down one quarter provided it rebounds, it should not be really driving your long-term asset management approach. And then looking at performance over long-term time horizons, and then, and very importantly, assuming illiquidity. And so Yale, they looked at their portfolio and they said, if we're only paying out 5% of this pool every year, why do we only have 10% in illiquid assets? Frankly, we could have 85% in illiquid assets and still have 3 years worth of payout in liquid assets. And it really, most people don't think of things that way. And it's frankly, it's but at the same time, a naive but also a very sophisticated way to approach it in asking the question, which most people weren't even asking, just because there's this presumption that liquidity is a good thing. And so the other piece is really in rejecting these style boxes, because there are many very talented managers that can exist in between the styles, and you can miss out on them. And so essentially the idea was, let's lift these constraints that we've artificially applied, and the outcome was this endowment model, which has done so well. The other important development of Yale and their contemporaries was to be some of the first to embrace alternative assets in institutional portfolios in a significant way. So they really pioneered institutional investment in venture capital, private equity, significant allocations to hedge funds, opportunistic real estate partnerships, oil and gas investing, timber, agriculture, these areas which really go beyond traditional stocks and bonds. Endowments were the first and quite successfully able to allocate into these, starting in the late 80s and into the 90s in a meaningful way. So I think we have another poll question at this point pertaining to alternatives.
All right. And just as a reminder for everyone, I'll leave it up for about 60 seconds after we launch. Okay, does your institution's portfolio include alternative investments? No, less than 10%. More than 10%, but less than 20%. More than 20%. All right, I'll leave it open for about 10 more seconds. Okay. 10% said no, 50% said less than 10%, and 40% said more than 10%, but less than 20%.
That is interesting. So most fell between 10 and 20, it seems. Or I'm sorry, less than 10, and then second best or second highest between 10 and 20. So I think that's very indicative of most portfolios. And I think most people, and this is totally natural, they take a stepwise or an incremental approach to it, where they say, hey, we'll allocate 5% and then we'll go from there, which is perfectly reasonable. But if you think of it, it's more of a psychological journey to get there than necessarily just saying for the portfolio, where would we want to end up, and let's go there. And so Yale has been known for having up to 80% of their portfolio in alternatives. And again, they've been doing it for a very long time, and it took them time to get there, but they really pushed the envelope in terms of illiquidity complexity. Here's their historical asset allocation dating back to the middle of 2000, again through the middle of 2019. And if you look at the orange at the very bottom, the first category, that's their U.S. equity, and they have less than 3% allocated to public U.S. equity. Almost 14% in international equity. They have almost a quarter of the portfolio in absolute return assets. So those are hedge funds that are pursuing some kind of a arbitrage or other strategy in order to try and generate what's called an absolute return. And that means a return that basically doesn't go up and down with the market. It should have a lower than equity, slightly lower than equity return over a full cycle, but much higher than bonds, which should not go down at the same time the market does. And they also have 37% currently, or at least as of a little over a year ago, in private equity, and that includes venture capital, 15% in real assets, which includes real estate, and only 8.5% of their portfolio in bonds. So it's a very equity-oriented portfolio, heavy on the alternatives, and very low on the asset class that most people have in our industry, which is domestic U.S. equities. And here are the results. So this is essentially since with the middle of 1999 indexed to 100, the Yale Endowment portfolios, the growth of their by return. So this is an index. This isn't actually the growth of the endowment, which has things like gifts and payout. This is just the index of their performance relative to the S&P 500 over that time. Almost with a terminal value over 20 years, almost 3 times that of if you had just invested in the S&P 500 over a very long period of time, 20 years. So it's not only a high-performing portfolio, but it's also robust in that it has held up well. It absolutely, they were hurt just as everyone was in 2008 and 9, but for the most part, they've been able to avoid the big crises and downdrafts in the market, in addition to having good return relatively year in and year out. So again, back to 2019, the decade from 2010 through 19, the S&P 500 had a great decade, was up 14.7% annually over 10 years. That's phenomenal performance for U.S. stocks over a decade compared to most other decades in the S&P 500's history. So a tremendous decade for U.S. stocks, large cap U.S. and growth. And if we look at just a global 80-20, 80% global stocks, 20% core bonds, the return was 9.6. Over that period, Yale's endowment returned 11.2%. So it did not keep up with U.S. equities over that period. Still had, by any accounts, a very good return for over a decade in terms of compounding and compared to many different balanced portfolios. But frankly, this is, and there were years during the span where domestic stocks and bonds did very well. And we saw news stories coming out asking, is the endowment model dead? Does it not work anymore? It's not keeping up with a simple 70-30 portfolio. And there were some years where that was the case. However, so that's the most recent decade, 2010s. For the prior decade, ending 2009, the S&P returned negative 0.2%, 2.2% per year. So the U.S. equities actually lost value over that prior 10-year period. Yale's endowment over that period returned 11.5%. So this is very illustrative of the fact that there are things in that portfolio that don't rely on the domestic stock market going up and growth, and in particular, increasing valuations. So pretty astonishing that in 2 decades that were very different from from a mainstream asset return perspective, notably U.S. equities, that Yale's performance was over 11%, kind of regardless of what was going on in the U.S. equity market. And the other thing is that only one of those years, which was the fiscal year 2009, was a negative year. So that's for institutions that pay out every year, that's an important factor. There was volatility in the Yale portfolio. It's not a, they don't do 11% every year, but due largely to that large allocation to absolute return, they've only lost money, at least in the last 20 years in one period. Okay, so I want to make a note about how they've done this, and he even makes the point in his book that this isn't for everyone, and it's not necessarily solely just a matter of asset allocation and allocating to these asset classes. You have to have superior manager selection. So some of the large endowments, Harvard used to, they've transitioned away from it. I know Columbia does a bit. They invest directly in securities, but Yale has really, along with all of the people who have left Yale and gone to other institutions, they partner with external investment managers, and their business is to have a team that can do diligence and find and build relationships with excellent investment managers in public equity, private equity, venture capital, hedge funds, and those types of things, and build relationships where they're with those managers for many, many years once they've decided that they want to partner with them. And so as a result of endowments and large endowments taking this approach, they have kind of become very attractive to investment managers. Managers would love to have Yale as an investor in their portfolio, partly because it signals that, a sign of approval, and it makes fundraising much easier for them. But also in general, they like to have people who are thinking long term, who are willing to ride through ups and downs with the manager, and really understand what they do, and therefore will understand if there's a period where they're underperforming, why that is, and kind of be understanding of that. And so that has put a virtuous circle together where some endowments, large endowments, are able to find and then secure allocations in some of the top managers, and that is absolutely a key part of the return associated with the endowment model over time. And so a good example is MIT, which is headed by Chief Investment Officer Seth Alexander, who came from Yale. They invest very early. They will identify managers before they've even raised any money and be their first investor. They do a tremendous amount of due diligence to understand the manager's investment judgment, even if they don't have a portfolio track record of their own yet. And they invest with them very early. They grow with them, and they expect to hold on to them for 10, 20 years, assuming that their judgment or their due diligence pans out. Very different approach from some investment committees and some consultants who are, frankly focused on how did our mutual funds or our managers do last quarter or last year, and if they didn't have a good quarter, maybe they go on a watch list and we consider moving on from them. It's very different nature of relationship between the allocator and the manager than that type of governance. Okay, so active management, as I mentioned, very important to have diversified sets of equity exposures, as well as diversification by manager, and then also to be with managers who are able to add value. So alternative assets being a big part of that, it can be limited. It can be difficult for smaller and newer entrants or adoptees of the endowment model to frankly to execute that part of the strategy. It takes resources, either internal or external, who can do the due diligence work, understand the managers, be able to evaluate managers and their investment judgment, and partner with those that are going to add value. And Yale, so this is the disclaimer that, you know, this is difficult to execute because they have, based on their history, reputation, their team, their experience, they're able to do this. This is no small part of their track record, which I described above, as a function of the types of managers they're with, which goes beyond their approach to asset allocation. Okay, and I think that's the end of my formal remarks. I think we have one more poll here, and then we can take questions if there are any questions.
All right. So just as a reminder, before I launch, we'll leave it up for about 60 seconds for everyone to answer. Okay, do you think that incorporating elements of the endowment model could improve your institution's portfolio? I do, or I don't. All right, we'll leave it up for about 10 more seconds. Okay. So we had 100% of respondents say they do.
Excellent.
All right, so we do have 3 questions here, Andy, so I can go ahead and start reading them off if you're ready.
Perfect.
Okay, so the first question that came in was, does the quote-unquote growth figure include the yield or only growth?
I'm not sure where that, I'm not sure the context of
I think it goes back to the beginning with your graphs.
You think it's the efficient frontier? If the person that asked that could
I think it was, yeah, starting with the efficient frontier, those 3 that came in a row.
Okay, so
that's when the question came in.
Okay, so in this case, the return, or the expected return, is the total return. So it includes income, it includes expected capital appreciation, you know, from earnings growth in the case of equities and that sort of thing. So this is, yes, this is a total return metric for both stocks and bonds. I hope that's responsive.
Okay, yeah, and you know, if you have a follow-up question, you know, if you'd like us to elaborate on that, please obviously feel free to type it in the question box. Next question, is a 5% withdrawal rate good for the longer term, or is 3% more reasonable?
Well, that's an excellent question. So I think, you know, given there's an interplay between, in this case, the endowment model was developed based on the expectation that 5% it was what they would spend, and you also wanted to keep up with inflation. So there's this concept known as intergenerational equity, which means you're being fair to different generations. You're being fair to the generation that is here today, and fair to the generation that will be here in the future, by allowing your portfolio to keep up with inflation. And so the 5% plus inflation essentially was kind of a given, and for foundations in particular, that is a statutory minimum. And so then the approach was then designed to meet that. Now, at that time, expected returns, again, from bonds were much higher, and so there was a lot more, frankly, the valuations were more reasonable, although maybe not so much in 1999, but that was more achievable. But I totally agree that under today's investment environment with yields at zero, if an institution has the ability to pull back that payout rate to something approaching 4, or even lower, it becomes much more achievable, much more sustainable to achieve intergenerational equity rather than spending too much today, and then, many years from now, decapitalizing your long-term pool. So I think if you have the ability, then yes, it's much more achievable given where valuations are in both the stock and bond market, to reduce that payout rate.
Okay, thank you. And then the last question we have here is, how can the little guy tiptoe into this approach, this investing approach?
That's an excellent question, and it really depends on how little, frankly. There are some, so I would say, in order to really avail yourselves of alternative investments, there are thresholds, where you're a qualified purchaser and that sort of thing. Below 25 million, you have to be. There are some things that are available to you, but fewer than if you're above 25 million. And so, even at 25, frankly, most endowments, when they reach $1 billion or greater, is when they think about hiring a chief investment officer and building out a staff to actually implement this on their own without the help of consultants. So I think probably, given the response to the poll, where many of the participants have started to allocate to alternatives, that's the way to start to implement some of these components of the endowment model. Certainly not 85% illiquidity overnight, but moving into it and adding some value by using those alternative investment strategies that are both diversifiers and have higher return. And while Yale probably is not in favor of things like fund of funds because of the extra levels of fees, I think those can be, there are mechanisms, using a consultant, using a fund of funds, where it is worthwhile to get those benefits, even net of the additional fees. And the other thing I'll mention is the endowment model, at least originally, and Yale's approach, was really a mindset that, again, went back to first principles, looked at the problem, looked at the institution and what they were trying to solve for, and then tried to throw off these preconceived notions or these industry practices that kind of ultimately became constraints. So I think just going back to using a very analytical approach for every decision, not kind of, frankly, if you have a low payout of 5%, not saying, well, we can only have 10% illiquid, just because liquidity feels good to have, if you don't actually need it. If you need it, you should definitely reserve liquidity. But as a governance matter, I've seen committees really constrain themselves by psychological aversion to short-term volatility, or just even sophisticated investment committees that I've been around, where they overvalue liquidity, which they don't need from a purely clinical perspective in their portfolios. So I would say just embracing that mindset, and thinking big picture about, wait a minute, why are we doing this way? Is it just because this is the way it's always been done? Or, could we maybe throw off some of those constraints and pursue something that could get us to a better place without really losing much of anything?
And Andy, we just had another question come in, actually. Can you discuss the portfolio bleed from investment fees? What type of fees are acceptable?
Absolutely. Fees in alternative investments are higher. And so I think the key element to examine is the post-fee expected return and the post-fee return. So as an investor, I'm averse to fees. I think we should negotiate every point we can. I think if we're not getting return from active management in a sector, we should not be paying for active management. And if that means going passive in certain sectors, absolutely, that's the thing to do. However, I'm not going to sit out something that has a 30% net return just because there's a 30% carry associated with it. I'm very focused on what that net expected return is. And if a manager is absolutely the best, frankly, they're going to probably push their fees. And so paying 2 and 20, or I'm generally averse to higher than 20% carried interest on partnerships most of the time, but that's not absolute. There are those who I'm willing to pay that because they're so good. So I would say, absolutely focus on what that net expected return is, net of fees across the board, and really only pay premium fees for that when you're fairly certain that the active management is a big component of the return.
Okay, thank you. So that's all the questions we have.
Okay.
Thank you so much for attending today. If you have any follow-up questions that you'd like to share with Andy or myself, please feel free to email us, and we're happy to answer those questions. And again, have a great day.
Yeah, so thank you, India, and of course, thank you, Andy. And just before we sign off, just as a reminder, I'll be sending out CP credits in the next week or two for everyone. And really quickly, before we sign off, I just want to put in a quick plug for the next Region 4 HFMA webinar, which will be on February 25th from noon to 1 p.m. And it'll be called Revenue Cycle Challenges plus COVID equal Operational Chaos. It'll focus on breaking down revenue cycle challenges that likely got magnified or exacerbated during COVID. So with that being said, I would just like one more time to thank Andy and India for presenting today.